Hello, everyone, and welcome to Not Just for the Rich, using charitable giving techniques to solve real-world tax and financial planning problems. This webcast is brought to you by CPA Practice Advisor Magazine and TIAA Kaspick. I'm Gail Perry, Editor-in-Chief of CPA Practice Advisor, and I'll be your moderator today. Before we get started, let me explain how CPE works for this webcast. The webcast qualifies for 1 credit of continuing professional education, and also this webcast qualifies for 1 IRS continuing education credit. If you plan to earn credit for attending this session, you must stay with us for at least 50 minutes. In addition, we'll display 4 polling questions during the webcast. You'll need to record an answer for at least 3 of the questions, as this is our verification that you are still watching the webcast. Later today, you'll receive an email from CPA Practice Advisor that contains a link to your CPE certificate, assuming you met the requirements for CPE. If you're needing IRS CE credit, you should have entered your PTIN number when you registered, so we have that recorded. If for some reason you did not enter the PTIN number when you registered, you can enter it in that Ask a Question box that's on your screen, along with the name that you use for IRS registration, and we'll pick it up there. Please note that we can give continuing education credit for multiple people watching on the same computer. So if there are others in your office who would like to attend this event at the same computer, please have them join you now. And at the end of the event, we'll provide an opportunity for you to send us their email addresses so they too can receive credit. At any time, you can enter any questions you might have in the Ask a Question box on your screen. And our speakers will try to get to as many questions as possible during the presentation. Questions not answered during this live webinar will be addressed by the speakers afterwards via email. The slides for this webinar are available for download by clicking the Event Resources option in the bottom left corner of your screen, and then click on the PDF file that's displayed, and then you can download and save that. Today, we are joined by Denise Johnson and Bill Knox with TIAA Kaspick, and now we are ready to begin.
Thanks, Gail. This is Bill Knox here, and I am introduce myself very quickly. I'm our Senior Director of Technical Consulting and Strategic Innovation Projects at TIAA Kaspick. I'm coming to you from our Redwood Shores near San Francisco office out here in California, and I've been in the planned giving, charitable giving world for a little over 20 years now. Denise?
I'm Denise Johnson. I'm a Senior Technical Consultant based here in the beautiful Charlotte, North Carolina. And I've been with Kaspick for about 2 years, but the few years before that was with an accounting firm. So I'm wishing you all the best of luck for your upcoming busy season.
That's fair. All right, let's go ahead and jump right in today and see what's on the menu.
But we'll get started. Right, Plum? So we know there are many different types of life income gifts that you see here on our menu. There's a gift annuity, a deferred gift annuity, a flexible deferred gift annuity, annuity trust, a unit trust, or a flip trust. But as an advisor, we would never just present the whole menu to a donor or describe each option and expect the donor to make an appropriate choice. So instead of a menu, the better approach is the gift planning approach. So on the surface, these may be new to some, but they do require some skill and practice to apply effectively. So first, we want to uncover the donor's objectives, which involves asking the right questions and capturing the right information. Then we want to identify funding assets, which is all about helping the donor figure out how are they going to fund this gift. And then finally, we would explore solutions, meaning put all the pieces together to arrive at a solution that works best for the donor and the charity, which might involve a blend of outright and deferred gift components. So on the screen, you'll see a proportion of life income gift dollars from all TIAA Kaspick clients over the last 5 years. In short, 87% have been, this is probably no surprise, but these are the gifts that are most often fulfilling the objectives of the donor and the institutions. But some of you are newer to gift planning, right? I'd like to just explain some of the basics about these gifts so we're on the same page. At the highest level, all life income gifts work in the same way. The donor transfers assets, generates an income stream for himself or someone else for a term of years over the lifetime, and then the donor gets to take an income tax deduction upon funding the gift, and when the income stream ends, the balance passes to the charity. So let's walk through how a gift annuity could be a solution for your donor. So if the life income gift is a gift annuity, the payments will stay the same for life. So for example, if the donor qualifies for a 6.5% rate and makes an $100,000 gift, the donor will receive $6,600 a year, every year for the rest of their life. So this is the case even if the assets used to fund the gift is exhausted. So hopefully the gift doesn't run dry, and at the end there's a sufficient remainder to support the organization. Next, we'll outline the charitable remainder unit trust. So if the life income gift is a charitable remainder trust, the payment stream looks quite a bit different. So here, our donor establishes a 5% CRUT using $200,000, the $200,000 funding amount, or $10,000. In year 2, if the trust goes up in value, his payments will too. But as you can see here, in year 4, his payments go down. This is because the trust value has gone down. So the obvious question here, Bill, is why would a donor want a more volatile payment stream? So what's the incentive?
Yeah, there's a lot to think about when it comes to finding the right gift for your particular donor. And a lot of it has to do with, which one is going to make more sense based on their entire circumstance. And so if we look at our menu and we can compare our options together, we can see there's a few different similarities and differences between a charitable gift annuity and a charitable remainder unit trust. To start off, both offer legal agreements, right? You both have to sign a legal agreement to create the charitable gift. With the gift annuity, it's really just a simple contract that you'll sign with your favorite charitable organization and transfer the assets over, and then they'll start making those annuity payments to you on an annual basis. With the unit trust, it's a little bit different, a little more complex, right? It's still a legal document, but it's not a simple contract. It's a full trust document, and there's strict restrictions on that, both at the state level and at the federal level under Section 664 of the Internal Revenue Code. And some terms that have to be in there, and it has to qualify as a trust under state law. There's also some restrictions on the beneficiaries. For a charitable gift annuity, you are limited to no more than 2 annuitants on any one charitable gift annuity. So you can fund multiple annuities for multiple different beneficiaries, but every contract is limited to at least to no more than 2 annuitants. With the unit trust, you have a lot more flexibility. You can name 1 beneficiary, you can have 2, you can have 10 if it qualifies under the 10% minimum deductible interest rule. You can also create it for a term of years, but you can't really do that with an annuity. You can commute the payments to a term of years, but you can't draft it as a term of years annuity. But you have that flexibility with the unit trust. Now, they both produce an income tax deduction, which is good news. The calculations are a bit different between the 2 different kinds of gift plans. So a 6% annuity will not produce the same charitable income tax deduction as a 6% charitable remainder unit trust because the calculations are a bit different. They'll be close, but they won't be exactly the same based on that formula. Now, from the donor's perspective or the beneficiary's perspective, they're going to want to know how they're paid. And they'll get their payments according to what they establish within each legal contract, whether that's an annual payment, a quarterly payment, a monthly payment, how they choose. At the end of the year, though, they will have different tax forms, receive different tax forms in order to report those payments to the IRS. So with a gift annuity, you get a 1099-R tax form that shows you the amount of payments that you receive. Where with a unit trust, being a trust, you're going to get a Schedule K1, just like you would from any trust in a 1041, although we use the 1041 form to report the information to the IRS. The trust itself files something called a 5227 report of the actions of the trust. But the beneficiary payment will receive a K1 for their payments. The funding assets also differ for what you're going to use to fund one gift over another. With a gift annuity, generally speaking, you're using cash or securities. It is permissible to use other types of assets, and some charitable organizations will accept them. But because there's some state level restrictions on how the charity has to invest that asset, what they can issue an annuity for, what kind of assets they can hold in the reserve pool, you tend to have more organizations focusing on the cash and security side for what they will accept an annuity for. The unit trust is different, right? There's no charitable level of an investment pool that has to be maintained. It's the trust itself that owns the assets. And so you see a lot of variety. We certainly see a lot of variety of different assets that can be used to fund a charitable remainder unit trust. There's cash and securities, just like there is with a gift annuity, But there's a lot of times there's real estate or tangible personal property or intangible assets or intellectual property. You name it, we've probably seen it across the board. We've seen bug collections in real estate and cash and securities and cars and antique collections, art. We've seen just about all of it. So the unit trust, again, is a little bit more flexible when it comes to the kinds of assets that can be used to fund the gift. The big difference, though, is in the type of payments. With a gift annuity, you have a fixed, solid payment, as Denise showed you earlier. It's going to be, steady throughout the year, and it's backed by all of the assets of the charity, not just its gift annuity reserve pool. And so if the charity has to sell chairs to make those gift annuity payments, they'll sell chairs to make those gift annuity payments. Now, that might be a bit of an extreme example, but it is safe to say that the assets of the entire charity do back up those gift annuity payments. A unit trust, however, is a bit different. They're variable payments, right? So you revalue that trust every year. You attach your payout percentage rate to it, and that's what the beneficiary receives from the trust in any given year. And the payments are not backed up by all the assets of the charity, but they are backed up by the assets of the charitable remainder trust. So a properly drafted and appropriate payout rate and quality investment performance within the trust itself is imperative to make sure that the trust lasts for the intended term of life or the term of years selected by the donor at the creation of the trust itself. So that begs some further questions. What is the prevailing wisdom, and how should we be looking at what these gifts are and what do they make sense? Well, there is an idea, as I said, the prevailing wisdom that suggests really that a younger person is more appropriate for funding a charitable remainder unit trust because they have a longer horizon of time. The gift will last longer, and this means that inflation has more of an impact on the income stream, and the unit trust can help mitigate that a little bit. Not eliminate it, but mitigate it a little bit. And so for younger donors, we tend to recommend a unit trust payment because they have that longer life expectancy and horizon on the gift itself. On the other side, for an older donor, they have a shorter horizon, generally speaking, and an annuity payment might be the better choice. Of course, for the older donor, the older you are when you fund the annuity, the higher your annuity rate is going to be on that charitable gift annuity. And so that might push the donor towards the choice of a charitable gift annuity as well. But as you can see, there's considerable gray area in between when you have kind of those middle-aged donors, right? And additional individual circumstances and what asset they want to use might influence the gift, and also what they're looking for out of the income stream itself. Are they looking for more surety? Or are they looking for a little bit of flexibility and accepting some additional risk based on that? So we're going to take this prevailing wisdom tool and we're going to look at it throughout the day today, the rest of the seminar today, and figure out which one might make the most sense for donors. And we'll test our prevailing wisdom to see if this actually makes sense. But Gail, I think here we should turn to you for a polling question, and then we'll move on from there.
Yep, we're ready for our first polling question today. Remember, you'll need to answer at least 3 questions in order to qualify for CPE or CE credit for this event. So the first question is, just a minute, my dog's barking, sorry. The first question is, which of the following is not an incentive for a donor to create a unit trust? And the answer options are A, variable payments can help offset inflation. B, there will be a remainder gift for the charity. C, flexibility on the number of beneficiaries. Or D, simple contract. So choose the answer that you think is most likely to be correct and then click submit. If you have any trouble today answering any of the CPE questions online, because sometimes if you're on like a tablet or something, the online answering doesn't always work. You can always type your answer in the ask a question box and we'll record it there. So let's go ahead and take a look at how these answers are coming in. And it looks like overwhelmingly, I won't give it away yet because we still have some people waiting to answer. We'll leave that up there for a little bit longer. Oh, you can see the results. They're coming in, and it looks like more than half are choosing D, simple contract.
Yeah, and that's exactly right. Gift annuities are drafted with a simple contract, and where unit trusts require, a more complex trust agreement. That's correct.
Okay. Oh, and then did you want to do the second question? I think we have 2 back-to-back here.
We do.
Okay. We're going to go ahead and move on, close this question and move on to the next one, which is, why might a CGA be more appealing to a donor? And the options are A, a fixed annuity payment, B, donor can fund the gift with real estate, C, unlimited annuitants, or D, higher interest rates than other types of life income gifts. So go ahead and again choose the option that you think is most appropriate. There are kind of, I was going to say there are no wrong answers. There are kind of right and wrong answers, but you still qualify for the credit if you post an answer. So it's not the end of the world if you get it wrong. So, okay, and we'll leave that up for a little longer to give people a chance to answer that one. Okay, I'm thinking most of our answers are in right now, and we should be sharing the results with you in a moment. It looks like the majority of people, about half, have picked a fixed annuity payment.
And that's correct. Yeah, the certainty of fixed payments is certainly appealing to a lot of the donors that we encounter over time. It's a nice way to project your income going forward. And so the fixed payment on the annuity is a real selling point for most beneficiaries. Okay, well, thank you, Gail. For the balance of the presentation, what we're going to do is take a closer look at the gift types and some of the key differences between them. And so our objective, I mentioned a minute ago, is really to understand whether the prevailing wisdom, why it is what it is, chances where it might not apply. So, suffice it to say for now that whether donors realize it or not, they're trading off different types of investment risk, right, by choosing the different types that they can give. And these risks are common to all investment portfolios. They're not, they're not exclusive to charitable gift annuities or charitable remainder trusts. And so, as effective planners, we need to know something about the risks and how they can play out in the real world for donors. And we'll do that by giving you an example of some real world situations Kaspick has encountered over time. And we're going to do that by looking at, first the pattern of the payments, what that looks like for a donor, purchasing power of the payments over time. And then we'll round out by talking about the total value of the payment stream when you take into consideration the charitable income tax deduction and tax savings from that a donor is going to be very interested in looking at when they fund a charitable gift annuity or a charitable remainder unit trust. So let's go ahead and start with that pattern of payments. And Denise, I'll kick it back to you.
Thanks, Bill. So in this chart, we're comparing nominal payments from a 5% unit trust and a 5% gift annuity. So this chart is basically showing us what everyone's likely wanting to see, right? The unit trust payments have the potential to grow over time, and annuity payments stay flat. So the math isn't all that difficult. There's a 6.5% return minus a 5% unit trust payout rate. And here we're ignoring fees for the illustration. And then therefore there you'll see the 1.5% growth in the unit trust payment each year. So the unit trust payments grow, but the annuity payments do not. So here again, we don't necessarily know the patterns of returns, and the straight upward line can be a little misleading for charitable remainder trust. So here the chart outlines returns from 1926 to 2023 on a 70-30 portfolio split of U.S. stocks and bonds. So average return is the center line, and then we put a -2 or +2 around the average. And then the blue lines here show that there's only 6 times within the year span that hit that 2% percentage average. So therefore, payment volatility then is a problem, right? Nobody cares about volatility on the upside, but the payments can drop rather steeply from one year to the next.
Yeah, I think that's a great point. When you look at that high level slide of that upward slanting blue line, it's a little misleading. Now we'll see that over time that can work out, but it's rarely that simple, right? There's up markets, there's down markets, and they can change within the same year, as we all know. We've all witnessed and been through. And so, just showing your clients that upward sloping blue line for the unit trust versus the fixed line for the gift annuity isn't really telling the whole story. And so maybe we should take a look at some of the ranges over time and see what that volatility looks like. Well, generally, the longer horizon you have, the narrower the range of annual returns that you're going to see. And so what I put together here is this graph that shows you the ranges of returns for every 1 year, 5 year, 10 year, 20, 25 year period, going all the way back to 1926. So for the 1 year period, the ranges are quite significant, right? I mean, you could be anywhere from negative 31.3% all the way up to a return of 38.2%. That's a gigantic, unknown for that 1 year period of time of where we're going to look at, where we can land with our volatility in the payment streams and the values over that time. But the longer you go out, you can see the narrower the band gets. So for the 5 year period, maybe 1926 to 1930, 27 to 31, and so on, the range narrows from a low of negative 6.7, which is a lot better than a negative 31.3, right, to a high of 22.3. That's still a pretty wide band when we're looking at volatility over that time. And it gives you some lack of assurance, right, on what your returns are going to be. And that's how the market works. We can't know for sure how it's going to work. But again, the longer we go out, the longer the duration, the longer the horizon on that gift, the little bit more assurance that we can get. So like for the 10 year period, for example, the range is narrowed, quite a bit. We don't see any negative numbers at all anymore for the 10 year average. It's between 1.8 and 16.5. That's still a pretty big range, right? We've started to eliminate some of the negative downturn, but a 1.8 return, especially when we look a little bit later at inflation adjustments, isn't a great return on that valuation. But the 16.5 would be pretty good. So again, pretty large band of volatility in there. But once we get up to the 25 year period, the range is much lower. You have a low return of 5.7%, again, on average, and a high of 14.9. That's still a pretty big band, right, when you really think about it over time, from 5.7 up to about 15% return. But we're on the positive side. And 5.7 is not terrible. It's not where we want to be on any particular year, but it's not the worst return that you've ever seen over time. And so if you're averaging somewhere in that band, at least you're hopefully growing depending on what your payout rate is on your unit trust. And at least you're not hitting too much of a wall when it comes to your charitable gift annuity as well. So what this shows you in totality is that the longer the horizon, the tighter the range of returns. So that volatility becomes a little bit less of an issue as we go through it over time. So then you have to look at volatility in a real life scenario. So Denise showed you that gently sloping blue line or aggressively sloping blue line that showed the unit trust growing over time. But let's look at how it really worked. And if we can take a portfolio glimpse at something that Kaspick uses, it's our Kaspick TIAA growth allocation. And that's a 71-29 mutual fund bond split. We can see that it's not exactly a gently sloping line, right? That light blue line here is showing you a projected return, showing a long-term return of about 7.6%. And you can see, it's going up over time, right? It's a good, decent return at 7.6%. And it's nice and smooth. And we see that illustrated to donors over time. But really what we need to look at is that dark blue line, right? And it shows the actual returns, not what we project at 7.6, but the actual returns for any 1 year period of time. And the effects on the payment, as you can see, is fairly dramatic, right? Now, generally, even that dark blue line is kind of moving in that same direction. It's keeping track with our light blue line, what we illustrated. But in any 1 year, it can vary quite a bit. And so we start in 1996, and then we get to 2004, and we had a pretty strong rise in returns about that time. And then the financial crisis brought a significant drop, as you can see that in that 2008 financial crisis. So a beneficiary expecting consistent growth could see quite a dramatic change in valuation over time, right, from 1 year to the next. So general trends are what they are, and we can say that, we're going to average about a 7.6% return over time. But that's an average, right? It's not the amount we're going to return in any 1 year over time. That's the long-term average that we're looking at. And so there is, some significant volatility that we need to consider for our donors' payments and what they can accept. If this is too much swing from one payment year to the next, maybe a unit trust isn't the right thing for them to take a look at. But I wanted you to be clear, and so your donors can be clear as well on how these gifts actually work over time. It's one thing in projections, it's another thing in the real world circumstance. So Denise, maybe I'll come back to you to talk about our gift annuity versus unit trust results.
So here we can see the pattern of payment. So the annuity is flat, where the unit trust grows. So what's happening? Well, quite simply, the investment return assumption is higher than the payment for the unit trust. So each year the corpus grows and payments along with it. So we also can see what happens to the account value over time. So in this case, since we're investing both gifts the same way, the annuity is growing more in the remainder value because the growth in the account does not become a higher payment for the donor.
Yeah, exactly. So let's take a look again, maybe more in a real world example and some of the things that Kaspick would see based on our returns. So here you can see a hypothetical trust that was created, way back in 1962. So it was a pre-69, charitable gift, and they stayed pretty flat, for many years. As you can see, it kind of tracks along with that 6, going above, going below, over time. It was pretty flat. But there's a pretty steep drop, right, in that 73 to 74 bear market. You can see that's a pretty significant drop that occurred during that time. However, recovery in the markets did lead to a pretty good increase in payments. At the same time, the annuity payment, that light blue line, stayed consistent. So returns went up and down over the time. The payment from a gift annuity is not going to change based on market conditions. It's going to stay pretty flat. You're going to know the exact dollar amount that you're going to receive as an annuitant over time. So what if we use a different starting point then? Because remember, this is back in 1962. Let's look at one that maybe created in 1990. And if we're looking at a 1990 hypothetical trust, you can see that right off the bat, there is an initial drop. Right? You can't control for all of that. You can only predict, but you can't be assured on what's going to happen over that time. But after that initial drop, you can see a pretty good payment stream growth over time. But later on, there were some big effects, right? First from that dot-com bubble, you can see the big drop there. And then a nice increase, right, to back up over where we were even before the dot-com bubble. And then another drop right in time for that 2008, 2009 financial crisis. And since that time, we've seen trust values continue to grow back up, from that unfortunate drop in time. And so, again, the actual performance is a bit different than you're going to see with what you're projecting out over that period of time.
So what's our first conclusion? We basically have to accept the possibility of growth in payments by choosing a unit trust that come with some important uncertainties, right? You'll see the fluctuating payments. And then if payments generally rise, it's not smooth. So it varies up and down from year to year. And then in challenging market environments, payments could drop significantly in a single year. So even through growth, it's hoped over time, there can still be some significant periods where payments might not grow.
So, it's a good point. I mean, it's, you got to go into these things with your eyes open. That doesn't mean you can predict, again, what the market's going to do and what the effect is going to be on your charitable remainder unit trust in any one given year. But suffice it for your donors to understand, as Denise just went through with you, that markets change. And when you use a unit trust valuation, so do your payments. And that's generally trending over the life of the contract, the trust, in an upward direction, assuming you have a reasonable payout rate versus earning rate on your charitable remainder unit trust. But any one year can be pretty impacted by what the market is doing. With a gift annuity, on the other hand, you're staying relatively flat. You know exactly how much money you're going to receive every year. And that dollar amount never changes. But that brings us to our next issue that we should probably take a look at, and that's the purchasing power of payments over time. And there are some risks that lurk here that we need to take a look at. Then that really, as you probably are aware, is the effective inflation on payments as they occur, both from a unit trust, but particularly with the charitable gift annuity. So let's go ahead and take a look at that. So when you're talking about purchasing power, as I said, we're naturally talking about the effective inflation on our payment stream that we're receiving, from our gift annuity or from our charitable remainder trust. And what we've done in this graph here is show you a trailing 12-month inflation rate for the last 20 or so years. And so as you can see, for much of the recent decade, inflation seemed pretty much not an issue. It wasn't something that was talked about too much. People didn't feel the effect of it nearly as dramatically as they have over the recent term, right? It's been back with the vengeance over the last few years. Although it is off its recent high from memories in that 2002, 2003 period of time. But it's still not gone, right? In fact, we see a little tick up even today from where we were the day before. So inflation is not going away. It's an issue that even in the relatively flat years does have an impact on the payments. And when inflation rears its ugly head like we've seen in more recent years, it can have a dramatic impact on your payment and your purchasing power, on what you're able to use that money for over time. So how does this inflation affect the choice in the gift type? Well, it might seem kind of intuitive for you, but again, let's take a look at more of the real world example and some of the things that Kaspick has seen over that time. Okay, so bear with me through this slide. This is a little bit of a slog through this one, but I think it's important to understand the inflation impact on gift annuity payments. So payments from the gift annuity will lose purchasing power every year when inflation is taken into consideration. So how do you begin to understand that so you can explain it to your clients? And I think that's really important, again, that everybody goes in with their eyes wide open on these particular financial vehicles. Well, the first thing to consider might simply be a side-by-side comparison and how a $6,000 annuity payment fares under different inflationary rates. And you see that green line at the top there is our nominal annuity payment that we're going to be paying out from our charitable gift annuity over this 20-year period. And the dark blue line, we're applying a 3.25% inflation rate. And that mirrors the very long, actually over 100-year inflation rate average. But even with what seems a fairly modest rate at 3.25%, you can see our $6,000 payment is taking a hit, right? It's only worth a little more than half of the amount of the purchasing power 20 years down the line. And remember, that's a $6,000 annuity payment. It's not changing. You're getting $6,000 every year. And while $6,000 had a $6,000 purchasing power when it was created, 20 years later, that $6,000 payment in today's dollars is only worth about $3,000. So just about half, but not quite half of what it was before. And so that has a pretty big impact as years go by. And that's just, at the tail end, of course, again, as I said, every year along the line, we're having a little bit more impact on that purchasing power from the payment. Now, if we use the lighter blue line, what we're looking at is a 5% inflation rate and the effect of that payment over that same 20-year period. And as you can see, again, each year the fixed payment amount is less and less until we get out to our 20 years. And the payment's now less than, it's about $2,200. So even less than it was previously. So it's lost more than half of its original purchasing power value over time. So what does this tell you is that, this could be a blind spot for some of your donors. They're thinking about fixed, secure income from a charitable gift annuity. And that's true. But they might not have been thinking about inflation, well, maybe not until more recent years lately, from donors looking at that impact and how it's going to affect their gift. And they do tend to fail to understand this over time. So if you need to be able to share this information with your clients so they can understand what the impact would look like. You're trading a little bit of flexibility in variable payments for a surety on the fixed dollar amount, and that can impact again based on the purchasing power. So if your client, is 82, it might not matter to them as much, right? Their horizon's shorter. The effect of inflation is not going to be as much. They're unlikely to make it out to that 20-year term. Maybe they will. We often say in our industry, if you fund a gift annuity, you tend to live longer because we see donors that do that, and they tend to live, beyond what the IRS life expectancy chart will tell them. But if you're taking maybe a 68-year-old, they have to understand that gift annuity payment is going to, be affected by inflation a lot more over their 20-year horizon on their life expectancy. And so maybe, based on their age, their younger age at 68, the gift annuity might not be the right gift for them because that effect of inflation is going to have a big hit over time. And so that's something to take a look at on the gift annuity side. But we also need to look at it on the unit trust side because, again, inflation rears its ugly head everywhere. It's not just on charitable gift annuities. It also erodes the purchasing power of charitable remainder unit trusts. And so if we look at unit trusts, over that same period of time, we have a 6% charitable remainder unit trust payout rate. And we start with that $6,000 nominal payment. You can see by the end of that 20 years, that nominal payment has risen, right, to $6,596. And so, it's an increasing payment over time. But if we look at the effects of the inflation, again, that same nominal payment that's coming from our unit trust now at a 3.25% inflation rate is down to about $3,500 in purchasing power 20 years from now. And at a 5% inflation rate, it's down to almost $2,500 or less than $2,500 in purchasing power. So, of course, the growth in the payments and the trust over time is going to help mitigate, but not eliminate the effects of inflation on our charitable remainder unit trust. So again, this is one of those issues we need to bring to our clients and say, you think that you need to think about inflation and how it's going to impact your payments. And the reality is it's going to impact your purchasing power either way. So which one makes more sense to you? Are you trading security in the fixed payment amount, or are you willing to take a little bit of volatility to get some upside risk on your payment stream over time? And I think a lot of that will have to do with, what risks your donors are going to want to take.
So we remember our first conclusion, which was the unit trust payments are uncertain, right? We saw the fluctuating lines. But then our second conclusion is, like Bill mentioned, inflation should be considered, right? Annuities are not as appropriate for younger beneficiaries. Unit trust payments help to offset the effect of inflation on the purchasing power of the payments, and purchasing power can be further eroded if a higher payout is selected, inflation is higher than expected, and returns are below average. So Bill,
Yeah,
let's move to our next polling
for our next polling question.
Oh, here we are. Ensemble.
All right, this is our third of 4 polling questions. And the question is, which gift type can lose purchasing power each year? The possible answers are A, gift annuities, B, unit trusts, C, both A and B, or D, neither, both hold their value year after year. So choose the option that is most appropriate to you. And then we'll leave this on the screen for a few more seconds to make sure we get all of the answers. Maybe just a few more seconds. 5, 4, 3, 2, 1. It looks like about 60% are saying both A and B can lose purchasing power each year.
Yeah, that's exactly right. Inflation erodes the purchasing power of the annuity just like it does the charitable remainder unit trust payments. And therefore, it can cause both of them to lose purchasing power, right? So you need to be aware of that going forward for your particular plans.
And so now on to our final area of investigation, which is what is the total value of the payment stream and the charitable deduction? So we've mentioned a lot during our time here. So you might ask, how do I go about estimating the total benefits to the donor of each vehicle? So here are some steps we've listed out, which is accumulate the payments over time, adjust payments for taxes, adjust for inflation, don't forget the tax savings, and then calculate the gift to the charity. And while we're at it, we should estimate the value of the remainder gift to the charity, since that is important to the donor and the charity.
So let's, again, turn then to the benefits for the donor and the institution and take a look at this is a tool that Kaspick uses with our clients. Our clients generally are the charitable institutions themselves that serve as the trustee of charitable remainder unit trusts or actually issue the charitable gift annuity. And we assist them with the investment management and the gift administration of these gifts. And part of our assistance that we offer is some calculation tools that our clients are able to use to be able to model some of these different gifts. And one of those tools that we use here is this really simple model that gives us a benefits comparison. And so what we have here is 100,000 gifts, and they're each paying, whether it's a unit trust or a gift annuity, 6%. Right? And that tends to be what we see, especially with unit trusts. They're somewhere between that 5 and 6% payout rate. The minimum payout rate in the charitable remainder unit trust is 5%. You can't go below 5% under the Internal Revenue Code. You can't go more than 50%. So that's a pretty big range itself, right? Between 5 and 50%. Generally speaking, we see that 5 or 6%, because again, the benefit with the unit trust is that you want it to grow over time to help the donor's payments also grow over time. And so by choosing a 5 or 6% payout rate, that allows the trust to grow, as compared to like maybe a 7, 8, 9% payout rate, then your returns in the trust will probably be approximately somewhere in that area. You might say stagnant, you might see the trust value go down every year. And so sticking with that 5%, 6% payout rate is generally where we see most of our clients' donors choose for their charitable remainder unit trust. Gift annuities are a bit different, right? The payout rate on those is generally established by an organization called the American Council on Gift Annuities. Most charities follow that prescribed rate schedule from the ACGA. Not all do, but the vast majority of them do. But for purposes today, we wanted to get a side-by-side comparison. So you can see, based on the donor's age, we'll say that they had a 6% CGA rate from the American Council on Gift Annuities, and then that 6% rate for the charitable unit trust. So again, we have a $100,000 gift. Each is paying 6%. We're going to ignore fees and assuming each account is invested in Kaspick's growth allocation, which is similar to an S&P benchmark at 70-30, although our growth allocation is a 71-29 split, invested in a series of mutual funds and fixed income bonds. And we're going to demonstrate about a 22-year horizon, so life expectancy on each of these types of gifts. So as you can see, from a payment perspective, the unit trust pays more and the payments grow over time, right? We've been through that a few now, so you're probably expecting that to happen, right? You wouldn't expect it the other way around. But from the charity's perspective, the gift annuity provided a higher remainder value over time. And so, it's one of those things to take a look at when you're looking at those benefits comparisons. We can also take a look at the effect of the deduction, and we do that by toggling on the right side there on our web tool to take a look at the donor's tax savings. And we do that, and it brings up another box in our software for us. So it allows our clients to enter assumptions about tax rates, both federal and state, how many years the donor is going to use the deduction over, because there are carryover limits, of course, with charitable income tax deductions that the donor really needs to consider with you, their advisor, when they're thinking about making a charitable gift, and how long it will take them to use that entire charitable deduction for the charitable gift. And again, so when we do that, when we toggle it over, we can take a look. And from the charity's perspective, again, the gift annuity provided a pretty good remainder value. The charitable remainder trust does as well, right? I mean, it's not like you're not getting a decent remainder value off either one. You could also provide some results considering inflation and also the taxation to the donor over time as well. And so it's, again, important really for the donors to understand what that's going to look like. And by using tools like the Kaspick offer with our clients, or similar tools that you'd have within your toolkit at your office, it's nice to model that, right? The effect of those payments are going to be, and then especially when we take into consideration that charitable income tax deduction. So there you can see that when we go forward, the effect of that deduction on there does tend to increase the overall tax benefit to our donors or clients. And that's not always intuitive either, right? They're thinking of it as in the sense of providing a charitable gift, and it's nice to get a charitable income tax deduction. But that deduction, as you all well know, results in savings to your client as well, in the form of taxes not paid. And so that does have a cumulative effect within each gift type itself, with the total value of both the income stream of the payments and the total tax benefits for funding that particular gift. I might add, of course, you can always go out in the market and get a SPIA, single premium immediate annuity, and you get generally a nice payout rate, but you won't get the charitable income tax deduction. And when your gift terminates, it benefits an insurance company rather than the charitable institution of your choosing. And so when you're looking at the total value available of your gift and how far your dollar's gone, either one of these gifts can make a real good sense to your particular donors. It provides them the income stream they're looking for, and it provides a benefit to their favorite charity for a cause that might be close to their heart. And I don't know about you, but for me, it makes me feel a little bit better knowing that my assets would be going to help myself and my favorite charity rather than my favorite insurance company.
And so our last set of conclusions recognizes the results that given long-term average returns and the same payout rate, The gift annuity benefits more the charity, and the unit trust has a higher benefit for the donor. And so, why would this be the case logically? Well, if the portfolios earn the same and the payments from the unit trust grow, more of the trust's total return is being shared with the beneficiary, whereas all the benefit of the portfolio appreciation accrues to the remaindermen when the payment is fixed like a gift annuity.
That's great. So what we're going to wrap up with here is a kind of a recheck on that prevailing wisdom, right? We started with the slide earlier in the presentation, and we said we'd come back to it. So I'm keeping my word on that. We're coming back to this particular prevailing wisdom chart. So how does it hold up now that we've gone through the economics of life income vehicles and understand some of the risks involved? Well, actually, it holds up pretty well, right? So, I mean, generally older donors with shorter horizons are going to be better off going with the charitable gift annuity. So it's a lot more predictable on the payments that are going to come out from that gift over time. And yes, inflation will affect the payments, but generally speaking, for our older donors with a less, a shorter life expectancy over time, the impact is going to be less than it would be for a younger donor to fund a charitable gift annuity and have that effect of inflation really start compounding as years get longer and they've been farther away from the donative date. And so again, generally younger donors are going to be more likely to have a longer life expectancy, a longer horizon for the gift before it terminates. And therefore, they have more ability to withstand those fluctuations. So you might remember that chart I showed you earlier where it's pretty lumpy from year to year, although the trend is going in the right direction up over that 20-year period. And as long as they can, take those lumps, right, year over year, and understand that there's going to be an impact in those payments from one year over the next, for your average donor, younger donor, the charitable remainder trust probably is just going to make more sense. Now, again, that's not always the case, right? It might be that they're looking at a fixed payment, right, and they want to fund it today, get their charitable income tax deduction, and not have those annuity payments kick on until some years down the road. And they can do that in a deferred payment charitable gift annuity. And so that helps, right? You get the deduction today, but you don't start payments until later on, and then your rate goes up over time. And so by the time the payments do kick on, your donor will have a shorter life expectancy. And so the effect of the payments might not be as impactful for that particular donor. Maybe they want the volatility over time, right? They see that they have a charitable remainder trust, and with your assistance or the charity's assistance, they're going to invest it in such a way that it's going to grow. Maybe they estimate that they can, outperform what they were looking at, or maybe they figure, the effects of inflation are significant enough in the current timeline that a unit trust makes more sense to be able to take a little bit of volatility to help offset some of that payment over time. And so that's really where that gray area is. And there is the prevailing wisdom, but it's not a one size fits all. You really need to look at how each particular gift works, what the purchasing power is that we've gone through today, the effect of inflation, and what it is that your donor's objective is, right? Are they looking for secure fixed payment? Are they looking for variability in payment that can hopefully offset some of that inflation impact over time? It really could go either way. And so it's an individual assessment that you'll make with each one of your clients to determine, how those gifts are going to be impacted, what they're going to do for your donor, and what it really is that they're looking for going forward. So you might ask yourself, after we've gone through all these risks, right, and showed you volatility in payments and decline in purchasing power, we focused on some of these risks, right? Are they so high that maybe life income gifts really just aren't very attractive to donors, or maybe even charitable institutions? Well, but if you boil it down to the fundamentals, right, the balance, the trade-off that you were asking your client to take a look at and be knowledgeable about before making the gift, you take that payment volatility and inflation in consideration. So if we do that, you have to balance some of that risk, as I said. This is no different from a life income gift than it would be for any other investment portfolio decision that you're asking your clients to make and you're reviewing with them. So, whether it's retirement savings or planning for college or going for the charity's institution endowment on their side, these are all market risks that are impacted in everything that we do and anything with our financial assets that we have in an institution. And so, there is that difference, that trade-off between payment volatility and inflation risk. But it is one of those things that's not unique, right, to life income gifts. It's across the board for any financial decision that your clients could make. And so that's why we wanted to come and speak with you today and show you a little bit about some of the different trade-offs inherent with gift annuities or charitable remainder unit trust to make sure that your clients can understand what those risks are. You're already doing this with them, right, in other areas when they're looking at some options for diversifying their assets or maybe even making a charitable gift. Of course, a charitable gift outright pays you nothing back, right? It's just an outright gift to charity, and you get some tax savings from your deduction. But utilizing these life income gifts gets you both, right? You get a smaller charitable income tax deduction than with an outright gift, but you get that ability to get some income back over time. And I might add, the charity will never be upset if you donate some of those income payments back year over year when your client might not need them. Or with your charitable remainder trust, donating the payments back to the charitable remainder trust over time to help ease the effect of the inflation and grow the corpus of the trust over time. So that years down the road, the value could be a little bit higher for those income payments coming from your charitable remainder trust. And so it is a balancing act, and we're confident that you're equipped to do it. And of course, you can always reach out to TIAA Kaspick or anybody else with any questions that you have. And we'll open it up for some questions here in just a few minutes at the end. But before we do that, I think we need to turn one more to the polling question to make sure you get your continuing ed credit. So Gail, I'll turn it back to you for our next polling question then.
Okay, this is our fourth and final polling question. And it is, what are the 3 things you should consider when recommending a gift type to your client? And the options are A, who are the beneficiaries, payment pattern, and the total value and charitable deduction? Or B, payment pattern, purchasing power, donor's state of residency? C, payment pattern, purchasing power, total value, charitable deduction? Or D, purchasing power, total value, charitable deduction, and funding assets? So pick the group that you think is most likely correct, and then click submit. And if you guys want to look at some questions while these are rolling in, you can do that.
I have a question here. Does the taxable income from a CRUT retain its character? In other words, qualified dividends, long-term capital gains, etc., when reported to the beneficiary as it does with other standard types of trusts?
That's a really great question. Yes, but with the caveats. Charitable remainder trusts are subject to a system of 4-tier accounting. It's basically, whatever the highest tax rate asset is in your charitable remainder trust must be passed out before the other assets are passed out. So, for example, if you have ordinary income that you've earned in your trust, your payments will first be ordinary income. After you've paid out all of the ordinary income tier, then you move down to your capital gain tier. And the same there, you pay out capital gain to the extent that you have it in the trust. After that, you move to what's the other income category, according to the IRS, which tends to be tax-free income from like municipal bonds, for example. After you've paid all of that, if you do, now you're eroding into the corpus of the trust more, and you're getting down to that tax-free return of your corpus or basis from the trust over time. So the character of the assets the investment retains its character inside the charitable remainder trust, although the payments from the charitable remainder trust are subject to that 4-tier accounting system. So that's why, it's a great question. So investment of the charitable remainder trust should consider the purchasing power of your payments over time, but also, your investment mix should be tax efficient in some way. You don't want to invest in such a way that you're only paying out ordinary income to the extent that's possible based on the funding assets. That's a great question.
Can you change beneficiaries year on year?
No, no. It is with a charitable gift annuity, for example. It's locked in, right? You can name 1 or 2 annuitants when you fund the gift, and then they receive the payments over time for the rest of their life. Similar with a charitable remainder unit trust, but there can be a little bit more flexibility. That's kind of a theme with unit trusts, right? They're a little bit more flexible. So you can bake in a little bit more flexibility with the charitable remainder unit trust. You can do things like name a class of beneficiaries if it's a term of year trust, where payments can be switched between the classes of beneficiaries over time. If you have an outside independent trustee, and the trustee is so willing, you can grant the trustee power to sprinkle, right, payments between beneficiaries. The difference is they have to be noble and living at the time of the creation of the interest. And if you're giving sprinkle power to your trustee, it has to be definable, right? So who are the parties within that particular class? So again, another good question. Gift annuities tend to have fixed required beneficiaries. Most charitable remainder trusts will. As a matter of course, we see them mostly based on one or two named lives, but it is permissible to name classes of beneficiaries and or grant your trustee sprinkle power. That's another good question.
The other questions were answered individually to the individuals who asked them. So I don't know if we want to turn back to the poll.
Yeah, so I think just a quick wrap up on the poll. Let's see, the majority of people, it was kind of across the board, but the majority of people picked the first option. Who are the beneficiaries, payment pattern, total value, charitable deduction.
And it's a good thought. And you're not wrong. But for purposes of what we're looking at today, we went with C based on the topics from our survey. Or our presentation today, but you're not wrong. Depending on who your beneficiaries are, what the payment pattern is, and your total deduction are all very important aspects to any one of these types of gifts. But for what we went over today, really focusing more on the payment pattern, the purchasing power with regards to inflation, and that charitable income tax deduction. Don't forget that. With these gifts, it's really important that you get that charitable income tax deduction for your donors that can use it. That's a big part of these gifts, right? They are charitable gifts. They're not just pure financial products that your donor or client is buying. It is looking towards the future, right? For both your income stream and for the cause that you want to benefit a particular charitable institution. And the deduction is part of that. You get a gift, right? You get an offsetting tax savings by funding a charitable remainder trust or a charitable gift annuity.
All right, I think that about wraps us up. Do either of you have any parting statements that you want to include before I give some more information to our audience?
I'll thank you for attending again today and hearing us out. I hope you are intrigued a little bit by gift annuities or charitable remainder unit trust, and you explore them a bit more. Kaspick has some information. If you have any specific questions, you can reach out, and we'll be happy to answer those questions for you over time. As Denise said, good luck as you round out this year and into tax season. I know several of you, most of you probably will lose a little bit of sleep in honor of helping your clients. It's a noble endeavor, and I wish you the best of luck, and thank you very much for giving us a little time today.
Thanks, everyone.
All right. Thank you, Bill and Denise, for an excellent presentation and an incredible amount of useful information. We hope all of you enjoyed this webinar. We want to thank you so much for attending, spending your time with us today, and thank you to TIAA Kaspick for making this event possible and enabling us to offer a free CPE credit and or CE credit to each attendee. As a reminder, you'll receive a link to your CPE certificate later today in your email. The CE will be directly submitted to the IRS. If you have any questions about CPE or CE credit, you can contact me directly at gperry, Gperry, at cpapracticeadvisor.com. Also, if others are watching this event with you at the same computer and they require CPE or CE credit, you can email me their names and email addresses, and if applicable, their PTIN numbers. Again, that's gperry at cpapracticeadvisor.com. Right after this event, you'll be presented with a post-event survey evaluation form. We hope you'll share your feedback with us so that we can continue to improve our webinar series. Also, this webinar will be available in an archived version on our site at cpapracticeadvisor.com/webinars in a day or two. So if you want to share it with anyone else, you can do that. Thank you so much, everyone, and our audio will end now.
Thank you.